And so we've had 3 rate cuts now, and what the market cares about is the backstop still in place? Does the market believe that if things fall apart, the Federal Reserve is going to step in? And judging by the market reaction so far, the answer is yes. I know they removed that phrase appropriate to sustain the expansion, but the other phrase that's been put in there, everyone seems to be happy with assessing the appropriate path of future cuts. So there you see the market. S&P was down about 4 points as we went into the statement. You see it's now turned into positive territory. These are very, very small moves. Bank stocks, which often move here, the KBE, which is the ETF for banks here, is essentially flat. It was down fractionally as we were going into that meeting. Let's call that essentially unchanged here. So the market is acting like the Fed is reduced global risk, that this mid-cycle correction, or whatever they wanted to call it, has been successful. If you look at what we've been doing this month, yields have gone up. The yield curve has increased. Banks have notably outperformed the rest of the market. Tech stocks, another cyclical group, has outperformed. And those defensive stocks, the consumer staples and utilities, they were the market leaders. They are not anymore. So a lot of people are very happy with what the Fed has been doing. Of course, some trade optimism is helping as well there. So everybody needs to believe that the cyclical story, they need more meat on the bones. The Fed convincing themselves that indeed that backstop is still there, I think, is the key story. Next up, guys, of course, the jobs report. Back to you.
All right, Bob. Thank you. Bob Pisani at the NYSE. Rick Santelli's tracking the reaction in the bond pits. Rick?
Well, Melissa Lee, the reactions aren't huge, but they are very important. Now, the dollar index is up about a dime. Since the statement was up 3, it's up about 12 or 13 now. If we look at 2-year note yields, 164 is where we settled yesterday. We went into this at 161 or at 163. So you can see we popped a couple of basis points to short end. 2s, 3s, 5s, they definitely firmed up. But when you go to the long end, which settled at 184 yesterday, the intraday low is 179. That hasn't changed. We were 180 going into it. We're still at 180. 30-year bonds are actually a basis point lower than when the Fed statement was read. They're down 5 basis points on the day. The curve has indeed flattened, but I'll tell you what, the Fed's out of tricks. They're giving all their treats away, and there is very little doubt in my mind that you're going to see a much more hawkish Q&A. That's just my opinion. The gold market, by the way, also dropped down, but it never went into negative territory, and I think you want to pay attention to gold with regard to should the Fed have done it, shouldn't they? Steve said they had to do something. Sure, that's a wonderful reason. Back to you.